In this module, we shall discuss the problems faced in measurement of government debt. Government debt is also known as public debt, national debt and sovereign debt is the debt owed by a central government. In simple words, the government budget deficit equals government spending minus government revenue, which in turn equals the amount of new debt government will need to finance its operations. In broader terms, the government debt may include all its liabilities. Such a broader definition includes the short-term and long-term obligations as well as the currency, which is also a liability. Taylor has defined the public debt as a form of promises by the Treasury to pay the holders of these promises a principal sum and in most instances interest on that principal. But in general, we exclude the demand debt, that is the currency obligations, from the public debt, especially we are concerned with fiscal policy only. However, the burden or the size of the debt measured at any point of time is not a true indicator because the burden that arises today is to be paid tomorrow. This needs a number of adjustments by keeping in account the expected rate of inflation, government assets, uncounted liabilities, etc. Besides, there may be business cycles which may increase or reduce the real value of the debt. Hence, we may discuss here the problems in measurement of debt as well as the budget deficit. After studying this module, you shall be able to know about the problem of choice of indicators while measuring government debt, to explore how inflation affects the measurement of government debt, to understand the capital assets are included while measuring the government debt, to examine the problems related with unfunded and uncounted liabilities while measuring the government debt, to examine the problem of measurement of government debt during the business cycles, to know about the accrual and cash indicators while measuring the government debt. We shall now discuss the problems in measurement of government debt. All the discussions on desirability of budget deficit and government debt finally reach a point on the differences of opinion in the measurements of debt as well as the deficit. The first issue is related with the choice of the indicator. The choice of the indicator. It is generally propounded that the primary budget deficit is the only relevant measure of the budget deficit, which is defined as a deficit net of interest payments. It is argued that the interest payments are a pure transfer without any economic effect. But when we have to measure the change in debt including interest payments is necessary, as delta dt is equal to gt minus tt plus rt into dt. It shows that the change in debt, that is delta dt, at any point of time is equal to the simple difference between the government purchases gt and the tax revenue tt plus the interest payments on the existing debt, that is rt into dt. Besides, to measure the long-term impact on deficit on the economy, it is suggested that the ratio of debt to GDP is a better measure, as it tells about if the debt is sustainable or not. If the GDP is growing at a faster rate than the debt, the budget constraints do not pose any hindrance to the government to raise more of the borrowings for its increasing purchases. However, a persistent increase in this ratio is a signal that the economy is not growing fast enough in nominal terms to service its debt. This also raises the alarm that unless the policy is changed, the debt will grow without limit and the interest payments to service the debt will be unbounded also. Inflation. Almost all economists agree that the government's indebtedness should be measured in real terms, not in nominal terms. The measured deficit should equal the change in the government's real debt, not the change in the nominal debt. The nominal debt is measured as a difference in nominal purchases and revenues plus interest on nominal debt, that is delta bt is equal to pt into gt minus tt plus it into pt into dt, where delta bt shows the nominal change in borrowings, pt is the price level, I is the nominal interest rate, when prices rise, the nominal interest rate also increases, as I is equal to R plus I, where R is the real interest rate and pi is the rate of inflation. From this, we may rewrite this expression of change in borrowings as delta BT is equal to PT into GT minus TT plus RT plus pi T into PT into DT, as delta DT is equal to GT minus TT plus RT into DT. This expression can also be rewritten as delta BT into PT into delta DT plus pi T into DT, or delta BT upon PT is equal to delta DT plus pi T into DT. It shows that the real value of the change in debt. We can also observe that if we do not take into account the real value of the debt, we will be committing serious mistakes. This can be understood in the following way. Let us assume that D is the nominal debt. Its value will grow at the rate of inflation, that is delta D upon D is equal to pi. That is delta D is equal to pi into D. In this way, the change in debt will be overstated by pi into D. This correction for inflation can be large, especially when inflation is high, and it can often change our evaluation of fiscal policy. Yet in reality, the inflation actually erodes the real value of the debt. Take an example that a country reported a deficit of $20 billion and the rate of inflation is 8.5%, and the government debt held at the beginning of the year is $500 billion. The deficit is overstated by pi into D is equal to 0.085 multiplied by $500 billion is equal to $42.5 billion. Thus, when we correct the debt for inflation, the deficit of $20 billion actually turns out to be a surplus of $22.5 billion. That is 42.5 minus 20 is equal to 22.5. Thus, even though nominal government debt was rising, real government debt was falling. Capital assets. It is generally believed that while estimating the budget deficit and so the burden of debt, we must take into account the capital assets, and the change in the value of these assets must be deducted from the government debt at any point of time. Taking into account the assets as well as the liabilities for accounting budget deficits is known as capital budgeting. Actually, when a government purchases some assets, it will not increase its deficit, as the increase in the value of debt will be offset by the equivalent increase in value of assets. Same is true for a sale of an asset. If the government sells an asset and uses its proceeds to pay off the debt, the budget deficit will not decline, as a reduction in debt will also be offset by the equivalent reduction in value of the assets. However, there are many controversies regarding using the capital budgeting to gauge the fiscal deficit and public debt. It is always hard to decide which particular expenditure should be counted as an asset. The problem aggravates when we are taking account of the deficits of the state governments, in whose case many infrastructure projects, for example roads, dams, etc. are the common assets, and which state would be claiming how much of the total value of the asset is a big question. Moreover, in the long run, the sale or purchase of a capital asset have a significant impact on the budget deficit and the repaying capacity of the debt by any government, for example sale of an asset, and using its proceeds for repaying the current debt may reduce the size of the debt in the current time period, but in the long run it will also reduce the earning capacity of the government, which will contribute to increase in budget deficit as well as burden of the debt in future time period. Similarly, if the government purchases an asset, though it may not be affecting the deficit through capital budgeting in the current time period, but in the long run the asset will add to the earning capacity of the government, leading to increase in capacity to generate income and so the debt repayment capacity. Similarly, there is a question whether we should include the physical capital assets only or the human capital assets should also be included. After all, the current expenditure on health, education, etc. also raise the earning capacity in the long period. Hence, measurement of government deficit and then its impact on government debt is a complex issue. Uncounted liabilities. There is a big question that how the future liabilities or the government guarantees should be treated. It has been found that the government guarantees, pensions, etc. pose a huge burden to the government in future. Pensions are as much a government obligation as a formal debt contract. The workers today provide labor services to the government, but part of their compensation is deferred to the future. In essence, these workers are providing a loan to the government. Their future pension benefits represent a government liability not very much different from the government debt. Yet this liability is not included as part of the government debt. According to some estimates, the implicit liability is almost as large as the official government debt. Same is true for the social security systems. Like pensions, the social security funds are also partial contributions by the individuals as well as the government, which the individual expect to receive in time of need. The old age pension scheme, accident benefits, insurance, etc. are examples of such schemes. In this way, these social security schemes are also future liabilities of the governments. Estimates suggest that the government's future social security liabilities less future social security taxes are more than 3 times the government debt as officially measured. But the critics say that the social security schemes cannot strictly be termed as debt, as unlike the debts, the repayments in case of social securities is optional. The government may at any time through passing a law may withdraw its liabilities at least partially if not fully. It may at any point of time annul some schemes, and these probabilities are higher where the government share is higher. Thus, in case of social security benefits, the government can always choose not to repay all of its debts. The government honors its debt only because it chooses to do so. Another measurement issue arises in case of contingent liabilities. The contingent liabilities are the liabilities which are due only if a special event occurs. The occurrence as well as size of these liabilities is not certain. The priority loans by the government, such as to students, farmers, small producers, etc., are examples of such liabilities. In these cases, the government guarantees the repayment of these loans. If these loans are not repaid by the borrowers, then it becomes a liability of the government to repay them. Thus, this liability occurs only if the borrowers default. Hence, it is difficult to have exact estimates of such defaults and then to include them in government debt. Government debt and the business cycles. Ideally, a fiscal policy should be counter-cyclical. The welfare governments must increase their expenditures when the economy is in recession and reduce it when the economy is booming. Thus, the budget deficit and so the government debt increases during recession as a result of the bailouts or social assistance programs to the employers as well as the employees. However, even if the government does not make any changes in its fiscal policy, the economic conditions themselves increase or reduce the debt in the same way. For example, under recession, people lose jobs. With dwindling incomes, the tax collection by the government falls, and if there are any unemployment allowances, the expenditures increase during recessions. Under such conditions, more of the people will be using the government run programs such as subsidized health and education, etc. This will increase government expenditure and reduce its revenue even if there is no policy change. Similarly, in case of trends of prosperity in the economy, people's income increases. This leads to inclusion of more of the people in tax net and lesser of them will be using subsidized goods and services provided by the government. Thus, the conditions of recovery and boom lead to increase in government revenue and fall in government expenditure, leading to a fall in government debt. But the main concern here for the analyst is to measure the determinant of the changes in debt. For them, it becomes hard to measure whether this change in government debt is due to change in economic conditions or due to change in government policy. In practice, both are working together and it becomes even more tedious to measure and to separate the effect of change in policy and change in economic conditions upon the change in government debt. In this context, there are suggestions that the government may use the method of cyclically adjusted budget deficits. But for this purpose, we must know the amount of tax revenue as well as the government expenditure. If the economy is working at the optimal level, that is, we are able to calculate the government revenue and expenditure at the natural rate of output and employment. In simple terms, a cyclically adjusted budget deficit is also known as full employment budget deficit. This cyclically adjusted deficit is a useful measure because it reflects policy changes but not the current stage of business cycle. Unfunded liabilities. An unfunded liability is a government commitment to incur expenses in the future that are made without provisions with corresponding revenues. In contrast to asset sale, which do not affect the fiscal deficit and so the budget constraint, the unfunded liability affects the budget constraint without affecting the current deficit. Roman 1996 says that if the government sells an asset, the budget constraint and its related policies remain unchanged, but in case of unfunded liability, satisfying the budget constraint requires the change in policies in such a way that they should be either reducing the government purchases or increase the revenue in future. In many industrialized countries, the social security and health insurance programs are generally the unfunded liabilities. Since there are uncertainties in the occurrence of these liabilities at any point of time, therefore, these are difficult to estimate. The cash and accrual deficits. The other main conceptual variation among conventional deficit measures is the choice between cash and accrual accounting. Some argue strongly in favor of cash deficit, where only government outlays for which cash has been disbursed during the 365-day period and only actual cash revenues received are included in the budget balance. Others argue in favor of completely accrual deficit, which attempts to capture the actual net resource preemption of the government, that is, the consequences of its policy decisions during the fiscal year, regardless of whether or not transactions have actually been paid for. A deficit calculated on basis of the system of national accounts would be an accrual measure. The public sector borrowing requirement is measured on a cash basis. In practice, countries' deficit measures lie somewhere in between the complete cash and complete accrual measures. Even in countries which use a cash deficit concept, interest payments are usually measured as they accrue rather than when actually paid. On the other hand, revenues are almost always measured on a cash or quasi-cash basis because tax liabilities may be disputed and some percentage will never be collected. Finally, the accounting treatment of expenditures can take a significant difference to the measured deficit. The administrative procedures for executing government expenditures are complex and take place in several stages from the time the government decides to undertake the outlay to the time the beneficiary considers himself or herself paid. Problems are further complicated when we take into account the timings of expenditures and revenue generation. Most expenditure commitments are made towards the beginning of the year and most payments are made towards the end. The institutional setup further complicates the economic analysis of accrual basis deficits as they are generally accounted to the budget document rather than to the fiscal year. In some cases, there are some complementary periods as well, which means that the accounting period is often prolonged beyond 365 days, which is the period over which transactions authorized in a given budget document may be carried out. Thus, in any fiscal year, transactions that change the measured deficit of the previous year can continue to take place alongside transactions determining the current year's deficit. In such cases, the temporal common denominator for analyzing the budget balance along with other macro variables is lost. Diamond and Schiller pointed out that if delays in payment are unanticipated, they represent forced borrowings, which misrepresents the cash borrowings by the government. The total reconciliation item between the cash and accrual deficits is often defined as arrears, but due to lags in the expenditure process, they complicate the exact measure of deficit at any point of time. Finally, another measurement issue is related with the issue of chits or bonds, which is recorded as a cash payment and thus inflates the recorded cash measure of the deficit compared with actual cash disbursement by the government. Let us now summarize what we have learnt in this module. In practice, fiscal policies may be applied inappropriately because conventional measures of fiscal deficit miscalculate the public sector's true budgetary constraint and have a misleading picture of the economy's fiscal stance. For diagnosing economic problems and finding appropriate fiscal policies to address them, the correct measurement of the public sector's net requirements is a prerequisite. But to understand a country's fiscal stance, it may be necessary to view the budget from several angles. It is suggested that the care should be taken about two main things. Firstly, the items to be included in the deficit as well as debt have to be defined clearly, and secondly, the time horizon should also be clearly delineated. Otherwise, there would be a number of measurement issues related with the rate of inflation, inclusion of capital assets, uncounted and unfunded liabilities, etc. The measurement of debt is also complicated during the business cycles. Finally, there are issues related with the difference of opinion regarding the inclusion of actual or accrual deficits. All these complexities make it impossible to compare the government debt not only intertemporally but also across nations, as a definition of the items to be included and the methodology to include them in the calculation of public debt varies from time to time and from country to country.